How about the numbers should be hitting any second here, Rick?
Yes. All those years, the central bank seeded the clouds of inflation. Now the downpour has started. Our September read on producer prices, the supplier's side of the cost equation, expected up 0.2 on headline. Multiply that by 2, up 0.4. That's the hottest since it was in June when it was up 1%. And if we look at ex-food and energy, which almost sounds silly because food and energy, especially energy, that's the big enchilada here. Ex-food and energy, it did come in as expected, up 0.3. And of course, in the rearview mirror, we have up 0.4. Don't see revisions yet. Now, if we strip out food, energy, and trade, it's double expectations, up 0.4. Now we get to the real numbers. Year over year final demand expected up 8.4 is hotter than expected, up 8.5. Now the high water mark for this one is going to be up 11.7. Yes, you heard me right, 11.7. That was in March. All the high water marks for producer prices were made in March. So that is indeed good news, 8.5. That almost sounds crazy in and of itself. Ex-food and energy up 7.2, a tenth light to expectations, a tenth light to the rearview mirror. High water mark in March there was up 9.7. And if we look at the final year-over-year number, this is ex-food, energy, and trade, up exactly as expected, up 5.6, which exactly matches the rearview mirror, up 5.6. High water mark was up 7.1. So if you're the Federal Reserve panel and you're looking at 8.5, 7.2, and 5.6, they have definitely moderated from extremes. Have they moderated enough for the Fed to put their neck on the block? I probably don't think so, and we'll see what the panel says. We see that interest rates have moved from a bit lower to a bit higher in yield as we continue to hover above 430 in twos, and you see the way it popped up on that number, whereas the 10-year actually didn't move very much. Much of the yields today have been under that 395 mark. 4% obviously huge psychological level. Panel, Joe, Steve, back to you.
Thank you, Rick. Let's get some reaction from our panel. Steve, we will go to you first. I don't want to have to go above any of those numbers Rick mentioned, even the 5, 6. I don't want to have to get above that. Maybe, we are sort of in a moderating environment, are we not? I mean, we're not going to hit new peaks in any of these numbers anytime soon.
Is that a forecast or a hope, Joe?
I got to start separating the two.
I know. I'm with you on that. Let me just tell you quickly what rose in this number here and why it's important for the Fed. A big chunk of the increase came from final demand for services, up 0.4%. A big chunk of that increase was in travel accommodation, and I think that's the new travel business adjusting to the. You had somebody on yesterday who said that it's just going crazy in terms of travel, lodging, that kind of stuff. So that's new demand there, and obviously we reported this quite a bit. You're still down 1 million workers in the leisure and hospitality business. I think it may be even 1.2 million last I checked. So what's important here is that you have this call from people saying the Fed is not paying attention to what's going on in prices. Well, maybe they are in the following sense. Goods prices have been coming down and moderating. It's the Fed's concern about what's happening in the service sector that has propelled them or motivated them to be cautious about the idea that inflation is coming down. What you're seeing here is that wholesale prices, you still seem to have rising service costs inside wholesale prices, and the concern is that remains the case inside of the CPI that we get tomorrow.
Shepard Smith here. Thanks for watching CNBC on YouTube.